Welcome to Cross-Border Tax Talks, where we discuss the latest trends in international taxation, from OB3 to the OECD's latest developments. I'm Doug McHoney, PwC's International Tax Services Global Leader. PwC's Pillar 2 engine, powered by Beacon, is a game changer for Pillar 2 compliance, provision, and modeling calculations. Built on a graph system utilizing over 20 years of international tax technology, this cloud-based centralized rules engine is developed by a team of Pillar 2 tax experts from around the globe. PwC's Pillar 2 engine is currently available as a service and is also available to license. On this week's episode of Cross-Border Tax Talks, we're in Washington, D.C. in PwC's Policy on Demand studio, where I'm excited to have Nita Asher back on the podcast. Nita is an international tax principal in PwC's Washington National Tax Services practice, where she focuses on inbound multinationals investing in the U.S. Nita, welcome back to the podcast.
Thanks for having me, Doug.
Well, I did the three-part series with Pat Brown covering OB3. It was the first time that really tried to put out a podcast almost on a weekly basis, very timely. It was sort of crazy, just all of the changes that were going to happen that didn't happen. And then we did the final podcast, but we really didn't get into a lot of the details. And so what I thought we would do is spend some time with you talking about what are some of these provisions that are applicable for inbound multinationals investing in the U.S. And then I'm going to do another one with Wade Sutton on the outbound implications. But before we dive in, maybe summer's wrapping up, kids are going back to school. I don't have any kids, but if I did, I guess they'd be going back to school. What did you do for the summer holidays? Did you go anyplace interesting, do anything fun?
Summer 2025 has been quite interesting, Doug, especially for those of us based in DC. I did manage to have a little bit of fun. A trip to Charleston, South Carolina with family, a trip to France the week of July 4th, where I was in Paris for a couple of days, and then biking through Provence. It was my first time on a hybrid bike. I cheated a little on some of the uphill biking, and it also came in handy when I had to pull to the side to check email about the one big beautiful bill that we're going to discuss. So nice to have that flexibility and a little bit of e-assist on hills.
Yeah, that week, obviously, for a week for vacation was challenging, right?
Not the best time.
As an international tax practitioner, we had OB3 getting finalized, obviously the G7 agreement, which we'll touch on, 899, and particularly in your area with inbound, people were absolutely panicked about BEAT, which we're going to talk about. So, that 4th of July was a crazy time.
And the heat.
Oh, it's been hot.
It's been real hot.
It's been super hot in St. Louis. And so my idea, Nita, of a good holiday is frankly not going anywhere, given the amount of time that I spend on planes and traveling around the globe in this role. So last week, I took a week off, hung out in St. Louis, and it was very, very nice. Not going anywhere.
I can appreciate a staycation.
Taking some time off. A staycation is the way I like to do it. All right, so let's dive in. And to remind listeners, the One Big Beautiful Bill Act, which we're going to call OB3 because it's too much of a mouthful, was signed into law by President Trump on July 4th, 2025, on your holiday, that extended permanently with modifications certain individual, business, and international tax provisions enacted as part of the 2017 TCJA, which you had a hand in when you worked for the government, that were currently set to change at the end of this year. The bill includes various revenue-raising measures, including changes to certain Inflation Reduction Act clean energy credits. So as I mentioned today, we're going to focus on topics relevant for inbound investment into the U.S., but many of these also are relevant for U.S. MNCs that operate in the U.S., so there's certainly going to be some overlap. As I mentioned earlier, Section 899, which had I think inarguably the biggest potential impact for inbound MNCs, was not included in the final legislation, but I will remind listeners that it could rear its ugly head again, and we'll talk about that a little bit later in the podcast. Also, I'll note that the changes to domestic research or experimental expenditures will be covered in more detail in the Outbound podcast, but again, all of these provisions really interact and are relevant for both inbound and outbound. So let's just start with some of the business provisions, and maybe the first one, which I think is very impactful for anybody operating in the U.S., bonus depreciation. Tell us a little bit about that.
That's right, Doug. So OB3 reinstates 100% bonus depreciation for certain qualified property. And this is typically equipment, machinery, short-lived property. It's really important. Back in 2017, TCJA had a temporary 100% bonus depreciation provision, and that started to phase out in 2023. And so what OB3 did, reinstate 100% bonus depreciation. It is permanent in a period of time where there's a lot of uncertainty, a lot of the provisions that we're talking about, and a lot of the provisions that inbound companies are looking at, modeling out. Some certainty with permanence is really welcomed. And so we have the permanent reinstatement, 100% of bonus. This is encouraging inbounds to think about investing in the US. It's also freeing up cash flow. Now, I do have to say there's a transition rule for the first taxable year after the bill was enacted to allow taxpayers to decide whether or not to apply the current depreciation percentages instead of taking advantage of 100% bonus. This is because I'm probably going to say this word multiple times. I don't know if you want to bet on how many times I say modeling.
Yeah.
Doug, it really is going to be a modeling exercise. As you noted at the onset, a lot of these provisions, they flow through other alternative minimum taxes or other provisions that inbounds might be thinking about in their overall calculations. And so it's nice to have 100% bonus depreciation. There are reasons, maybe even to have a more steady ETR. You might see companies not electing into 100% bonus depreciation. So just having the option is very welcomed for inbound investment.
Yeah, your point on the permanence, I think, is very important. As I travel around the globe in my role, it's always very curious for folks outside the U.S., like, why do you always have these provisions that are constantly expiring? And then you have to go into this explanation about our reconciliation process and the 10-year budget window. And so, to your point, the certainty now that multinationals face, now of course administrations can change, so the congressional power can change, but having these permanent, I think, is outstanding for whether it's inbound investment or just for investment in the U.S., creating that certainty for those investments. One of the things that Trump campaigned on was a potential 15% rate for domestic manufacturing. Obviously, that did not come in through OB3, but there was also this new provision called 168N relating to depreciation for QPP. Tell us a little bit about what that is and what that means.
Yeah, new 168N is in line with the Make Things in America campaign initiative. And what it does is it provides 100% bonus depreciation for qualified production property that is an integral part of a qualified production activity. And so what that means is you're looking for non-residential real estate that's used to produce certain tangible goods, so long as there is a substantial transformation, which is a term of art that you and I know very well from our time practicing in the subpart F space, so long as you have a substantial transformation of the product. Now, there are certain temporal components here, Doug. We talked about permanence with 168K and bonus depreciation. This new provision that applies to qualified production activity, it is limited in scope. It's a temporary provision. And so it applies to this qualified production property that's placed in service after July 4th, 2025, or that's placed in service after January 1st or January 19th, I should say, 2025. It's an important date because we all know the inauguration occurred on January 20th. So long that it's placed in service before January 1st, 2031. And so what that means, talking to certain inbound taxpayers, is they have to make a decision. Do they have property that they are, about to place in service? Well, then they might be able to benefit from this new provision, so long as they meet the other, requirements, which will take, some thinking through and data collection to make sure that they are eligible for this new incentive. And for those that are thinking about constructing manufacturing production facilities here in the U.S., can they do it within the window and have it placed in service by January of 2031?
Clock's ticking.
And so the clock is ticking. It's definitely an attractive incentive.
Sure.
But for inbound investment, trying to make sure that they appreciate all of the requirements to be eligible for this new incentive, and whether or not time is on their side and they can actually, place the property into service by this required time frame. Of course, there's always the hope that certain things get extended, but right now we have to work within the parameters that are in this new provision. And so it'll be interesting to see how inbound investment takes advantage of this new opportunity.
Yeah, the point on the issue of whether this can be placed in service on time by 2031 is just another example to reminding folks it takes time to actually build the manufacturing facility, whatever that might be, and then actually get that thing placed in service. And so very interesting provision, I think, to encourage domestic manufacturing, and certainly applicable both for inbound as well as outbound investment. The next one I wanted to talk about is our business interest expense, which we commonly refer to as 163J. I feel like some of our inbounds are starting to use more of the statutory provision numbers. Like everybody knows 899. So I do try to be mindful when we're talking about these provisions. So business interest expense 163J. What changed there?
Yeah, that's an interesting provision that has evolved over time. So our 163J, or thin capitalization provision, it is a limitation on deducting interest expense to the extent of 30% of your adjusted taxable income, or ATI. Pre-OB3, your ATI was determined based on earnings before interest and taxes, before being reduced by interest and taxes, I should say. And what OB3 does is it permanently reinstates the DA. So you start with your earnings before reduction for interest, taxes, depreciation, amortization, or depletion. And Doug, what that does is it increases your ATI base. And so this is really important because back in 2017, we had the ability to calculate ATI based on EBITDA. After 2022, we had the dropping, if you will, of the DA.
We couldn't save the DA.
We could not save the DA. And now what Congress has done, they've permanently reinstated the DA, increasing the ATI base, allowing for more interest to be deducted in the U.S. When we touch on the BEAT, I'll talk about some interesting interactions there. But I think that is a really important change, the permanent reinstatement of the DA. There are other changes that inbound investors are looking at. The changes with respect to interest capitalization and how it factors into your ATI calculation. A lot of times you might have companies, inbound investors, that elect to capitalize interest from a timing perspective. It can flow into other provisions or calculations, or even to overall ETR that is more consistent. And so there's this, well, instead of immediately deducting interest, we're going to capitalize it and amortize it over time. And what the OB3 does is it tells you to compute your ATI pre-interest capitalization. That could have an impact for companies that, opt to, and this only applies to elective interest capitalization, not mandatory interest capitalization. That is treated the way it is under, pre-OB3 law. And so that's an interesting provision to keep an eye on and to model out. Also, there are changes to how you take into account subpart F and guilty and corresponding section 78 gross up in your ATI calculations. It's very important because TCJA applied 163J at the CFC level. And there's a lot of regulatory guidance that in a CFC group election that helped manage the potential impact of applying 163J at the CFC level. To the extent inbound taxpayers have CFCs, they're going to want to take note of that particular change. I think, Doug, it's worth talking a little bit about effective dates here because the favorable change to 163J, the reinstatement of the DA, that applies to taxable years starting in 2025.
Yep.
So I'm going to use the buzzword again, modeling. It is a benefit that companies could take, but they might want to model out before opting into, more ATI for 2025 because of how it flows through BEAT and CAMT, which we'll discuss. The so-called unfavorable provisions, the provisions that impact or change the way interest capitalization factors into your ATI or the way you take into account subpart F and guilty and section 78 gross up. Those apply generally starting in 2026.
Yeah, prospective.
Yeah.
All right, so let's move on to FDII, foreign derived intangible income, which is FDDEI, which is now foreign derived deduction eligible income, which I think now we're referring to as FDDEI, because the intangible piece really wasn't that relevant. So first of all, maybe remind folks what is the new FDDEI, the old FDDEI, and then why is this relevant, particularly for how can this be relevant for inbound taxpayers?
Yeah, so the new FDDEI, formerly known as FDDEI, which has been changed significantly, and I know you're going to touch on that in the webcast with Wade.
Yep.
It's an incentive. It's a provision that was enacted back in 2017 to encourage certain services and sales activity to occur in the U.S. with respect to customers located outside of the U.S. And we have a lot of inbound taxpayers that also benefit from this incentive. It fits within the, America First or Made in America policy. You want certain activities and you want certain goods to be manufactured here in the U.S. to serve non-U.S. customer bases. What we need to keep in mind with the OB3 changes, to the extent you have an outbound transfer of property, you're no longer able to claim the FDDEI benefit.
Which gets you down to a 14%
That
rate.
14%, Doug, and I should have said that at the onset. And there are also some meaningful changes. You no longer have to take into account Q-buy. Also, there have been changes to the way you allocate expenses in order to determine your FDDEI benefit. Inbound investors are going to, want to think about where they place R&E, because R&E no longer reducing your DEI could have a beneficial impact on your FDDEI calculation or benefit. So thinking through where R&E activities are located is going to be helpful potentially for purposes of the FDDEI benefit, but also making sure to the extent there's an acquisition of, say, foreign parented group acquires Target, they might think, pre-OB3, well, we'll just transfer the IP with respect to this acquisition of a U.S. target to our foreign parent. That is no longer going to give rise to the FDII benefit, so it's something to take into account. This particular provision that applies to dispositions or transfers of property, it is triggered based on a June 2025 effective date. That is when the Senate introduced the Senate amendment provision that had some of the enhancements to FDII, which is now going to be called FDII. And so it's really important to think about, to the extent you're acquiring a target, where the IP is located, where the R&E expenses are allocated, because those are changes to the new FDII that's going to have an impact on inbound investment.
Yeah, we'll dive into more of those specifics, particularly on R&E in the Outbound podcast with Wade. But I think that point that you highlighted is just very important. Many inbound investors acquire U.S. target, just plan to get the IP back, put it into their foreign parent, the IP structure. And taxpayers should be mindful that's now subject to full corporate income tax. You don't get the benefit of the new 14% FDII rate. All right, let's move on to the Inflation Reduction Act credits, and we're not going to go through this in detail, but OB3 modifies, terminates, accelerates the phase out of a wide range of IRA clean energy credits, and these are highly complex, very specific, but maybe if you could provide just a quick overview, or what should inbound investors be mindful of, because to your point on modeling, many of them are thinking about what are those after-tax returns, after-tax consequences of these investments. Many of them have already included the IRA credits or benefits associated with the IRA. What should inbound investors be focused on?
I agree with everything that you just said, Doug, starting with, we're not going to go into this in great detail, but the changes to the Inflation Reduction Act credits was quite meaningful. So to the extent inbound investors have already engaged in projects in order to claim the benefits, they need to take note of certain timelines that require placed in service activities to be conducted in order to benefit from. There's an acceleration of dates in order to claim benefits. So if you are midway in placing a project in service to claim benefit, really check the effective dates that have been impacted by OB3. To your point too, there's an accelerated repeal of these credits. So if your models project out being able to claim the credits for a certain period of time, it's important to look at what OB3 changed, because it changed the effective dates of the vast majority of the Inflation Reduction Act credits. There's also new foreign entity of concern type provisions. I say new, there have been other provisions in the past that have foreign entity of concern type of triggers.
Foreign influenced entities.
That's right. And
prohibited
so,
foreign entities.
Prohibited foreign entities, these terms of art that are now included, or now have to be taken into account in attempting to claim the IRA credits while they're still available. So that's something else that we're seeing inbound investors take note of and include or update in models.
Yeah, and the advice that I would give is, even if you already think you've qualified, if you've already started construction, there's a whole web of rules about placed in service versus when construction was started. And it's all very dependent on whichever type of credit that you're actually going after. So I would highly encourage those that it's relevant, need to look at those individual provisions, because there wasn't necessarily one consistent change. It really depended on a credit by credit basis.
And we have an amazing team, Doug, way more qualified than I am,
that could
who
be
are digging into these rules and are helping our clients, both inbound and U.S. MNCs, navigate through the new hurdles.
That'll be a separate podcast.
Yes.
On that. One that I'm going to have to study a lot more for, too. All right, so let's move on to BEAT. So the changes for there were very minimal, but And we talked about this with Pat on the podcast, but I think what was even more interesting was what we thought might change, but then didn't change. So maybe give an overview, what's the punchline, what changed on beat, but importantly, what didn't change, because what didn't change could also potentially rear its head in the future. Then we'll talk about A99.
It's been quite the roller coaster ride with BEAT. I think the constructive feedback on BEAT started before it was enacted back in 2017. And just as a reminder.
Yeah, what is BEAT? Let's start with that.
It is the base erosion anti-abuse tax that is a quasi-alternative minimum tax of sorts, Doug. What it does is it compares regular tax liability to a modified taxable income base that adds back certain deductible payments made by a U.S. taxpayer or a foreign taxpayer that files an 1120-F to the extent the deductible payment is paid or accrued to a foreign-related party. And then also your regular tax liability in the comparative analysis is reduced by a host of credits, except the U.S. R&D credit and certain applicable Section 38 credits. And pre-OB3, the BEAT rate was 10%, but it was scheduled to increase to 12.5% absent any legislative activity. What was also scheduled to occur absent legislation was, I mentioned U.S. R&D credit, applicable Section 38 credits don't reduce your regular tax liability. That was scheduled to change. What Congress did is they maintained current law with respect to credits. So you don't have to reduce your regular tax liability by the R&D credit or certain Section 38 credits, and it just raised the BEAT rate from 10 to 10.5, not the scheduled increase to 12.5. I think there are many other improvements to the BEAT that taxpayers would like to see. They didn't quite get them in OB3, but maybe in another legislative, package. We did see a BEAT HTE, high tax, exception raise its head. It
was exciting.
There's a lot of interest, a lot of excitement,
yeah.
But then a lot of questions. So with any high tax exception, you start with, clearly, if you look at the statutory rate, you're going to be able to qualify for the exception. But we know nothing in tax is easy.
No, it's never the statute.
International tax makes it even harder and more complicated. And so there's a lot of questions. How do you calculate, the 18.9%? And if you're slightly shy of that, there is a cliff effect where you can't claim the exception. But Doug, I think both inbounds and some U.S. MNCs would love to see that particular exception resurface. Either in a reconciliation bill where there's enough revenue to cover it, or maybe in a bipartisan bill, because we saw something similar in Build Back Better when it was running through the legislative system. So that's something that, popped up for a little bit this summer and then did not make it across the finish line. I think the TILIS bill, which you've discussed on other pods, where there's some improvements to the BEAT that would also tackle other credits. We get a lot of constructive feedback on foreign tax credits and other things that drag down regular tax liability, making more likely a taxpayer to have a BEAT top up. And so those are changes, didn't make it in. I go back, what happened? We are now permanent maintenance of how you treat credits in your base erosion minimum tax amount calculation, and then just a mere 0.5 increase to the BEAT rate instead of the scheduled 12.5%.
Yeah, and the threshold for taxpayers to be in the BEAT is?
Stay the same. $500 million of gross receipts based on a 3-year look-back period and a 3% base erosion percentage, which is great, because we're going to talk about 899 in a bit. That would have changed the base erosion percentage. But Doug, all of the other domestic provisions that we discussed earlier, when I say it's just a mere 0.5 increase to the beat rate and no difference with how you take into account credits. What we're seeing in practice, inbound investors, U.S. multinationals, also in their models, they have to take into account the changes to bonus depreciation, 174 domestic R&E, 174 CAP-A, and 163J. Those changes too, I mentioned earlier. Reinstatement of the DA, frees up, or increases ATI, you might have more interest expense. Great for reducing regular tax liability, but to the extent it frees up related party interest expense that is, taken into account in your BEAT calculation, that could be problematic and result in a BEAT top up. And so it's really important to model out how these rules interact with your BEAT calculation, 174 CAP-A. Again, I understand you're going to talk about this in more detail with Wade, but we're seeing an interesting impact in BEAT models. So on the one hand, increased 174 CAP-A for domestic R&E is very helpful for taxpayers, inbounds, and U.S. MNCs that manage their BEAT by staying under the 3% threshold, because your domestic R&E expenditures factor into your denominator, and that could lower your base erosion percentage and prevent you from being a BEAT taxpayer. And you get to determine whether or not you're a BEAT taxpayer on an annual basis. Very helpful. Now, if you're over the 3% threshold and you manage your BEAT exposure by having a high regular tax liability, to where when you're doing your comparative analysis, you're always going to be paying more regular tax than your base erosion minimum tax amount. The 174 CAP-A, domestic R&E expenditure, or again, bonus, things that drag down your regular tax liability might increase the likelihood of a BEAT top-up. And so what may be good for those that manage BEAT exposure by not being an applicable taxpayer could hurt those that manage BEAT by paying high regular tax. A lot to model out, and we're seeing, inbounds already updating models to determine whether or not they're going to take advantage of some of these benefits that are available for 2025.
So maybe a couple of observations. First is they didn't change this acronym, and one could argue that this really isn't a base erosion and anti-abuse tax because the payment, as we note from the high tax exception, doesn't need to be to a low tax jurisdiction.
Very astute, Doug.
And so they did not change that. Maybe we'll get that change, but that wasn't even proposed, the change to the acronym. I mean, they changed GILTI, FDII, so they left the acronym the same. Second point is that I think a lot of taxpayers, you're very excited about the bonus depreciation, where we started. Oh, this is great. We can lower our U.S. tax liability. This is one of the BEAT is one of the two sort of whipsaws, if you will, that be careful. You lower that income too much, your BEAT you could end up with BEAT exposure. And then maybe the last thing, and we've beaten 899 to death, and Pat and I talked a lot about it, but I think there were a whole lot of inbound taxpayers that frankly didn't spend any time thinking about BEAT because they were below the 500 million gross receipts threshold. 899 would have eliminated the threshold. And so that any taxpayer, you still have to do the comparative calculation, any taxpayer with outbound payments could potentially be subject to the BEAT. And we know there's been the G7 agreement, and would just welcome your brief thoughts on, listen, we'll see what happens with the G7 agreement. It's just an agreement. These rules need to get transposed into some form of administrative guidance. And now I think our latest count is we have 56 countries that have enacted these Pillar 2 rules. And so all 56 of those countries and the 35 plus that had those enacted in 2024, and particularly the IIR in 2025, and 2024 and 2025, we'll see what happens with Section 899, what happens with this G7 agreement. It is possible it could rear its only head. But any observations or your thoughts on that entire 899 experience and where we might be headed?
It was an experience, Doug. And, retaliatory provisions are not proposed or enacted necessarily to raise revenue. It's to serve a purpose. And here some might argue 899 just merely proposed and going through the system served its purpose, and we got the G7 political agreement. As you noted, timing is of the essence here. And it will be interesting to see what we get out of the inclusive framework by way of administrative guidance and what we see other jurisdictions, how they're implementing what was agreed upon by just the G7. As you noted, the chances of, we're already hearing Speaker Johnson talk about another reconciliation bill, maybe two more reconciliation bills.
Feels ambitious.
Feels ambitious, it does. But, so did a July 4th.
I whiffed on that one.
Hence me riding bikes in Provence, thinking maybe I don't need to cancel the trip, and I'm glad I didn't cancel. But,
great point.
There are certain boxes that have been checked by this administration and Congress. I do think what we see coming out of the inclusive framework and whether or not the side-by-side, agreement is actually carried out could influence whether or not we see another Section 899, which not only had the parade of horribles with respect to the BEAD, as you noted, changes to the threshold, changes to certain really important exceptions like the services cost method exception, the U.S. withholding tax exception. I think, making the BEAD better, not worse, would be something that, again, would get a lot of his support across the aisle, but we need to monitor that. And then also the changes to the withholding provisions in 899 outside of the BEAT context. So keeping our eye, because there could be an 899, and it could have significant modifications too, Doug, because we talk about the G7 agreement. There's a lot of concern about foreign investment in the U.S. being impacted. Maybe some of those concerns are going to be alleviated in a new Section 899 if we ever see it raise or resurface. So we need to keep an eye on the impact on foreign investment because, as we've noted, OB3 does a lot to encourage inbound investment in the U.S. and really, pushes inbounds to update models and talk to advisors about taking advantage of these opportunities. The threat of 899 undermines that, but we could see changes to the provisions in order to manage that while it's serving its purpose.
It's a great point. I mean, because we saw a lot of changes from the House bill to the Senate bill.
Oh, absolutely.
So, last topic that I wanted to cover, which you really didn't see any changes in OB3, is our corporate alternative minimum tax, not to be confused with the U.S.'s qualified domestic minimum top-up tax.
Not a KDMTT.
It is a corporate alternative minimum tax. Maybe briefly, what is that and why is this important or even more relevant in the context of OB3?
Absolutely, Doug. So the corporate alternative minimum tax was enacted into law by way of the Inflation Reduction Act back in 2022. And what it does, it looks at book income with certain meaningful adjustments and determines whether or not companies that are above a certain threshold of applicable financial statement income, $1 billion for U.S. multinationals, $1 billion of global AFSI, $100 million of U.S. adjusted financial statement income.
Billion overall, and then $100 million in the U.S. for inbounds.
For inbounds, whether they are paying a sufficient rate of tax, and it's 15% on your tentative, amount of CAMT on your CAMT base compared to your regular tax liability. And so that was enacted back in 2022. It paid for some of the Inflation Reduction Act credits that you and I discussed and certain other things that were a priority of the prior administration. We only saw one very small change to a specific CAMT adjustment in OB3. As you mentioned, some of these, favorable provisions, which reduce regular tax liability, could result in a CAMT top-up, both for U.S. multinationals and inbounds. So it's very important to model out, I think, from FDII or the new FDDEI, which we talked about. That is a preferential item in a CAMT context, which it could reduce your regular tax liability, result in a CAMT top-up. You might think, well, I'll get a CAMT carry forward. It's just a timing difference. I'll be able to utilize that carry forward, but I believe you and Wade might talk about some of the nuances, if you will, with the CAMT carry forward that we see companies, both inbounds and US MNCs, projecting out. They may not be able to fully utilize the carry forward. Do want to note that the carry forward is applied against regular tax liability plus BEAT. And so some of the inbounds that you and I work with, they're projecting out too, well, you might have additional BEAT exposure, but if you're a CAMT taxpayer, how is that factoring into your models? I mean, it's fascinating. For those of us who love working in spreadsheets, there's a lot of fun to be had right now.
We're beyond spreadsheets now.
Yeah. I am aging myself a little bit.
You are dating yourself.
But it is, it's a really interesting time. And so it's important to take into account 174, FDII, all of these incentives and how it factors into the corporate alternative minimum tax. Do want to note, expecting some guidance in that space. We saw a notice coming out with respect to partnership CAMT adjustments a week or so ago. So there's, we don't even have final regulations with respect to that particular provision. And now we're dealing with new legislation that impacts. So there's a lot of work going on in the government right now to get guidance out for impacted taxpayers.
So I'll end this, Nita, kind of where you started, modeling. And what's really critical the message that we wanted to get out to the inbound taxpayers, a lot of favorable provisions, very business friendly, potentially very cash flow friendly from a tax perspective. However, don't forget about BEAT. Don't forget about CAMT. They could potentially be whipsaws or effectively reduce what you might think would otherwise be a benefit. Modeling. Nita, thank you very much for coming on.
Thanks for having me.
So thanks for tuning in to this week's episode of Cross-Border Tax Talks. Thank you, Nita Asher, International Tax Partner in PwC's Washington National Tax Services Practice. I'm Doug McHoney, PwC's International Tax Services Global Leader. Stay tuned for another exciting edition of the Cross-Border Tax Talks podcast.
This podcast is brought to you by PwC, all rights reserved. PwC refers to the U.S. member firm or one of its subsidiaries or affiliates and may sometimes refer to the PwC network. Each member firm is a separate legal entity. Please see www.pwc.com/structure for further details. This podcast is for general information purposes only and should not be used as a substitute for consultation with professional advisors.